Thanks for clicking! It could be time for Canada to embrace the 30-year mortgage. This according to a recent article in the Financial Post that is making its way around.
What are you, stupid? Huh?
And it's not the first time that this idea has been brought up, with Jasmine Tour of Mortgage Professional Canada bringing up the idea in June of last year, and, as of more recently, the Canadian Home Builders Association bringing it up earlier last month. And while the article from the Post goes over the pros and cons of a 30-year mortgage, it comes alongside the release of the Bank of Canada's Indicators of Financial Vulnerabilities, which shows, shockingly, that 30-year amortizations are used primarily to gain bigger and bigger loans.
I didn't realize that.
Given that OSFI, Canada's banking regulator, just recently urged banks to remain vigilant amid heightened risk in the mortgage market, it's not clear that riskier and riskier loans are coming to a theater near us anytime soon. So what I want to do today is go over the Financial Post article, take a look at the report coming from the Bank of Canada, discuss some mortgage math, and take a look at what 30-year mortgages would entail. Canada's bond yields have been shooting up over the past week over hotter than expected inflation data coming out of the US, and we are expecting to get our own inflation data coming from StatsCan on March 19th. We'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these 30-year mortgages. On to the article. The article from the Financial Post asks, since Canada's housing affordability is reaching crisis levels, is it now time for Canada to embrace the 30-year mortgage? And on this, the Financial Post is half right. As we've seen in article after article after article, it looks like Canada's housing market is getting more and more unaffordable. So, are 30-year mortgages the answer? Well, on this, a bit of clarification is in order. First and foremost, Canada already has them, which the article readily admits, noting that you need a down payment of 20% or more to access them. And this is where the article's accuracy does get a little skewed, as it notes that some lenders, including Equitable, have amortizations of up to 40 years, which the lender announced in October of last year. However, what the article doesn't note is that amortizations over 30 years, anything over and above 30, are not available on the prime lending side. You have to go to an alternative or B lender to access amortizations over 30 years. In fact, when Equitable launched that product back in October of 2023, interest rates were expected to range right in the realm of 9%.
That's a good deal.
So that's not exactly prime lending. That's not what we mean when we're discussing 30-year mortgages. What we are talking about when we're discussing the potential increase to 30 years is what the Canadian Home Builders Association wanted at the beginning of February, which was 30-year insured mortgages. Those mortgages which allow buyers to have less than 20% down on the prime lending side. Those loans which are insured by the major mortgage insurers, CMHC, etc., which are currently capped at 25 years, which, as we'll see, is for good reason. At one point in time, Canada did in fact have 40-year mortgages on the prime side, on the A lending side. But eventually, those got reduced bit by bit in the wake of the 2008 financial crisis, down to the 25-year cap that we currently have. And the reason, of course, is that the greater amortization, the longer the period that borrowers have to pay back the loan, the greater the risk.
I have an idea.
Let's take a brief look at the difference between a 25 and a 30-year amortization and how that would play out in Canada. We'll use the current benchmark price of $718,000 using minimum down payment requirements, gives us a total loan amount of $698,000. While that does give us a $350 payment difference between the 25 and the 30-year, that also has a major effect in the amount of principal being paid down over that first 5 years, with the 25-year having $620,000 owed at the end of the 5 years and $643,000 left owing at the end of the 5 years for the 30. So, in purchasing the same benchmark home, those who took 30-year amortizations would have $20,000 less equity after the first 5 years.
You're welcome.
And this obviously increases the risk to the mortgage borrower, having much more less equity in the home after the first few years of repayment, which is why the government brought the amortization back to 25 years in the first place. And over the life of the loan, assuming they had the same interest rate for that entire 25 or 30 years, those who took 30-year mortgages would pay an extra $120,000 in interest.
I'm trying to help you, Jim.
So, 30-year mortgages with lower down payment requirements, as we saw, are riskier than those of 25, But what does it do to housing affordability? Does it change affordability that much to make it worth it? Let's take a look. We'll use that same benchmark home on a 25-year amortization with 4.84 rate. Right now, borrowers have to earn $170,000 to buy that benchmark home. If we bump that amortization up using that same 4.84 rate in a 30-year amortization with minimum down payment requirements, that $170,000 now buys a home worth $750,000. So the 30-year amortization increases buying power by about $32,000.
It's a game changer.
But, as even the article from the Post mentions, regulators are wary about increasing the affordability on the part of Canadians, as that would no doubt increase house prices in short order. And we saw this last year after the Bank of Canada paused rates, and we saw interest rates go down, though marginally. The benchmark price increased by $46,000 in just a few months. So, it's plausible that if affordability were increased with the 30-year amortization, the affordability on that benchmark price wouldn't be affordable for that long. And this notion that prices would increase, that buyers would use their increasing buying power to push up prices, is demonstrated when we look at the Bank of Canada's release of its indicators of financial vulnerabilities. During the height of the pandemic in late 2022, buyers who used 30-year amortizations were much more likely to take out loans that were 4.5 times their income than those who stuck with 25-year amortizations. The bank notes that the increase in the usage of these type of loans are an indicator of financial stress, as borrowers are more likely to fall behind on debt in the event of an unexpected shock. Which makes sense. If you have to use a longer and longer amortization to be able to afford the home, then of course your budget is going to be a bit more stretched than had you have used the 25-year amortization. And, as we saw, you're not paying down the loan as quickly. You're not paying it down as quick as you did when it was 25 years, thereby leaving the borrower more susceptible to external shocks, job loss, etc. So, while this isn't the first time that the idea has been floated that 30-year insured mortgages would help to increase affordability, and I'm sure it won't be the last, as we saw today, and as history tells us, doing so wouldn't increase affordability for very long for Canadians. What it does do is increase the risk. And CMHC said as much last year when the idea was floated in June, with CEO Romy Bowers noting that it just makes credit more available.
I had no idea.
Indeed, this idea has been discredited on numerous occasions, but continues to be brought up by the media and the real estate industry, which act like we don't know exactly what's going to happen if 30-year amortizations, 30-year insured amortizations are brought to Canada. Affordability will get better very short term. The real estate industry will get better very short term. And then we'll be left with the same problem when house prices increase as a result of the policy. Short-term gains for the real estate industry, long-term problems for the economy as a whole. The math and the experience shows that if you increase affordability by simply increasing the amortization, increasing the amount of time that borrowers have to pay off their loans, A, won't increase affordability for that long, and B, increases the amount of financial risk in the system, at a time when the regulators, when the banking regulator, when the Bank of Canada is trying to get the risk out of the system. With that said, affordability is largely going to be based off interest rates, which will largely be based off Canada's inflation rate, set to be released next Tuesday, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.